Wish has been crashing this whole year and it does not stop. Right now it is trading at $3.97 per share, and now I can say that basically I'm losing all my money with this company. Hello everyone, welcome back to the channel. Today we're going to talk about Wish, what has been happening with this stock lately, what is dropping right now, some news that came out yesterday that could affect the company even more, and also, I wanted to share with you guys why I first started investing in this company and what is my expectations and my plan with this investments in the coming quarters or years. If you're new to my channel, welcome. Please consider subscribing and smashing that like button since it really helps the channel out. I'm sorry about my voice. It's 7 a.m. I just woke up and I wanted to film this video for you guys. So let's go to my computer. Well, we can see here that the stock is actually down 80.20% in the past year. I first started a position in this stock, and I'm going to put a screenshot here from my Robinhood account on the 30th of December of 2020 when the stock was around $18 per share. Obviously, I was up about 77%, as we can see here, 1 or 2 months later when it got to $31 per share. I didn't sell at the moment, even though one of my cover calls got executed and I sell some of my stocks at the moment, but I bought right back. So since then, the stock is currently down 87.27%. Now, obviously, a lot of things have been happening with this stock, and obviously, I do have expectations from this company, which we're going to talk right now. Right now, the company is trading us at $3.98 per share with a market cap of $2.55 billion. It currently has a price to sales ratio of 0.97, and analysts are expecting this company to report a decrease quarter over quarter and year over year in their revenue of 16.90% for this year and 15.80% for next year. But let's start with what I saw in this company, because when we see their fourth quarter 2020, the first one that we ever had as they went public on December 2020, we can see that they had a growth of 38% year over year for the fourth quarter and had an increase of 66% in revenue per active buyer, which obviously was incredible, and they were expecting a growth of 70% year over year in revenue growth for the next quarter. So this was basically all the information that we had. Obviously, we had the S1 filing, in which they showed us that they were 90% mobile, 32% year over year in 2020 year over year growth. We saw that the revenue went from 144 to 455 to $1.1 billion to $1.7 billion to $1.9 billion between 2015 and 2019. So this company was certainly growing massively year over year, and their cost of revenue was kind of maintaining very well. Their margins were maintaining very well. Obviously, we can see that their sales and marketing has been high since 2015, but that is something that they have been improving since then. Obviously, we can see that here it grew massively and here as well, but they have been quarter over quarter, as I said in my previous videos, marketing is representing way less of the revenue than what it was last year. So obviously, the company at the moment was growing massively. I do understand that even at last year, they were having problems with quality of their products and their merchants. But in my opinion, they were growing massively, and it was mainly because of the growth that they were having in marketing as well, even though they were improving that. But then, when we get to the first quarter of 2021, they reported revenue growth of 75% year over year, and core market revenue per active buyer increased 76%. So obviously we know that the kind of growth that they had last year was because of the pandemic, and that they benefit from it just like any other e-commerce company. Now, we can see that they had an excellent growth in every segment of their business, 75% for the revenue, 40% for core marketplace, 14% for product boost, 35% for marketplace, and 338% for their logistics revenue. The problem started when we see that for the next quarter, the second quarter of 2021, they were expecting a growth of only 2 to 4%. And we understand the growth that they had in 2020 was mainly because of the pandemic, and we accelerated, and obviously they were not going to continue seeing that growth this year. It has been happening with any many e-commerce companies, we see that Amazon is not beating analyst expectations and that they grew about 16% last year, when Amazon is a company that tends to grow about 25 to even 30% year over year. So obviously, seeing that they were expecting a growth of only 2 to 4%, they had their reasons. They told us their reasons, and we were like, well, okay, but people started to get worried with this company, and the stock started to drop. The thing is that next quarter, the second quarter, they were not able to report a growth. They actually saw a decrease of 6%. So they were not only expecting a growth of only 2 to 4%, only they had a decrease of 6% in revenue for the second quarter of this year. That was the first thing that made the stock drop massively, because if we check the stock, this was on August 12th, and if we check the stock that day, even though it was already down massively, the stock dropped 19.77% that single day because of their revenue. Because during this earnings report, they had a decrease in revenue, but they also mentioned that they were expecting bad outcomes for the coming quarters, as they already noticed the problems that they had, and they were actually trying to rebrand or fix those problems with the product quality, merchant fraud, and all that, including delivery timing for their customers. So they know the problems and they have been fixing that. That's why we can see that in the third quarter, they actually reported a revenue of $368 million, which is a decrease of 39%. But little did we know, analysts were expecting basically this. They were able to beat analyst expectations in earnings per share, because analysts already knew that they were expecting a bad outcome for this quarter. Obviously, that's good and bad. It's good because they were able to beat analyst expectations, but it's bad because they had a decrease of 39%. A company that has been growing massively year over year since 2015, or at least since we can see their data here. Now, not only that, they had a decrease in every segment of their business, which obviously is not something that we like. But yes, they actually mentioned something very important here, is that during the quarter, they continue to implement their aggressive plan to make key strategic operational and structural improvements, which we believe will enable Wish to achieve its full potential. And in doing this, we expect to drive long-term growth and sustainable unit economics for our e-commerce platform. By redoubling our focus on our most frequent buyers, we are learning that features and products are most likely to catalyze our entire user base to engage and buy on Wish. We are confident in our ability to return to growth during the second half of 2022 while creating significant shareholder value over time. We already knew that they were going to have bad outcomes in the coming quarters, but now at least they are telling us when they are expecting to come back with growth to this company, and it will be in the second half of this year. Now, these are some things that they have been implementing in order to improve their company. They launched Wish standards, they launched Wish clips, they expanded the Wish payments option, and for logistics, they have been improving as well, as they know what the problems they have, and they have been rebranding their company for that. Now, this is a very interesting article from Seeking Alpha called Context Logic Time to Worry, in which they basically talk all about the good, the bad, and the ugly about this company, because we know everything that have been going up with this company, and the only thing that they had the only good thing that they reported last quarter, according to Seeking Alpha, was basically that their margins did not decrease. As I said here, net margins didn't decline further, even with all the problems that they have been having. Because one of the problems that they have been having is their active users, which is obviously something that we have to take into consideration. We can see that Context Logic classified 90 million users of monthly active users in the second quarter and 52 million as active buyers in the second quarter as well. But then in the third quarter, those 90 users as monthly active users dropped to 60 million, and the 52 active buyers dropped to 46 million. The MAA trend is really bad, and Context Logic is a risk of losing even more shoppers in the quarters ahead, as supply chain disruptions pose a challenge to e-commerce business, which obviously is something concerning, because if we want to continue seeing growth in this company, even though we already know that they will not see growth until the second half of 2022, we want to see this active buyers and active monthly users increasing. So one of the things that might have caused this is that they decreased their marketing expenses as they brought a new person for this and have been improving that part of their business, as marketing was a huge expense for their business and they were burning a lot of cash. So they reduced their marketing expenses, and the result for that is basically with almost every company that their revenue or their growth on their active buyers will decrease, because normally companies spend $1 in marketing in order to receive at least $1 or $2 back. So if they decrease their marketing expenses, the money that they receive will decrease as well. That's what has been happening with their monthly active users. And obviously, this is very important. The decrease in users is very important, because when Netflix reported the second quarter of 2021, we saw that their paid subscribers for UCAN, which is United States and Canada, decreased from 74.38 million to 73.94 million. That's less than 1%. That's about 0.5% decrease quarter over quarter in paid memberships. And everyone was saying that Netflix was over, that it was going to start declining, and they reached their maximum paid members that they can get, so that it was not worth it investing in that. And that was only a 0.5%. Imagine Wish, that they saw a decrease of 33% in monthly active users in the third quarter in comparison to the second quarter. Some of the risks that they talk about is basically the supply chain crisis that could set back Wish business during the holidays. The only positive catalyst for the e-commerce business is a reversal in monthly active users, which we believe that will not happen until the second half of 2022. Now, they did mention last quarter earnings that they will do a CEO transition, and that Peter, the CEO, will step down as CEO in next year. So they have until February of next year to find a new CEO and do a transition of CEOs, which in my opinion is good. So that is actually good news for this company. Now, and another thing that came out yesterday that is not good for the company is this. France asked search engines and app stores to remove Wish, which obviously is not good news. And we're going to see why. We can see that last year, the French administration in charge of consumer rights and fraud started investigating Wish. So what they did is that they ordered 140 different goods on Wish. Most of them were imported products, because they were basically worried that it was a bit too easy to mislead customers and sell counterfeit goods in Wish. So out of this 140 different goods that they bought, 95% of toys that they acquired on the platform didn't comply with European regulations. 45% of them were deemed dangerous. When it comes to electronic goods, 95% of them also shouldn't be available in Europe, and 90% of them were dangerous in one way or another. So even cheap custom jewelry sold in the platform presented risks, as 62% of the items they order are considered dangerous. Again, these metrics are based on a very small sample of 140 products. So yes, it was only 140 products, but obviously this is kind of concerning, not because of what the study that they did, because that is concerning, but also because they will remove Wish from France. So basically, any other country, European country, could follow their lead and do the same. And obviously that's not good, because Wish's European market is as big as the United States market. So obviously this will affect the company in the short term. I do have to say that it was only 140 different goods that they bought, even though that's a good study. We already know that Wish already knows this, and they have been working to fix that, because Wish already know the problems that they have with their quality products and with their merchants and frauds. That's why they came out with Wish standards. That's why they brought new 12,000 merchants, including Trespass, Dermafirm, and Shopango, and also launched all of these other things that are going to help with the innovation and growth of the company. Now, when I say that I lost everything with this company, is basically because my position right now is down big. And you guys know that, because I started investing at $17 per share. And even though I've been able to average down lately a lot, I bought way more at the beginning. So right now the stock is trading at $3.94 per share. Even though the market is closed, I'm down 75.60% in my position. It has an average cost of $16.50 per share. So the question is what I'm planning to do with this position, because I'm down big, and many might argue that I just should sell and continue with my investment and just invest this money that I have left and on other positions. But I have to say that when I started investing in Wish, it was because I was seeing potential in the long term. I understand that a lot of bad things have happened this year. Their decrease in revenue, their merchants, their quality products, their timing and delivery, which was not new when I started investing, but they are trying to fix that. Now they are coming with a new CEO as well. They have until February 2022 for that, and they told us that they will start with their growth in the second half of 2022. So I have been thinking a lot about this position since last quarter, since the second quarter. As I told you in my video, that quarter was really disappointed. I am disappointed at this moment. And the third quarter was bad as we saw a decrease in revenue, but we were already expecting that. So what I think I'm gonna do with this position is basically wait until February for the new CEO and until the second half of 2022 for the growth that they have been saying. If they're not able to comply with that, if they're not able to deliver that to us and bring a good person to the company, a good CEO, a good new CEO, and I don't see any improvement in the second half of next year, I will sell this position. Right now I'm not selling. I'm already down 75%. I will not add today as I already have a big position in this portfolio. You can see that it already represents about 8% of my portfolio, and I'm down 75%. So I'm not adding more to this position, even though it is at an excellent prices right now. I added at $5 and at $4, but I will not add more as I will be investing in other things, but I will be waiting for that for next year, their new CEO and the growth that they are expecting next year in the second half of next year. I would really like to know what you think about that and what are your thoughts on this company and what is your plan with this company. Thank you and see you next time.